The importance of financial planning lies in its ability to help individuals and organizations achieve their financial goals, both in the short and long term. By creating a roadmap for managing income, expenses, investments, and savings, financial planning provides clarity, control, and direction over financial matters. It enables individuals and organizations to make informed decisions, anticipate future needs, and navigate through life's uncertainties with confidence. Ultimately, financial planning is crucial for building wealth, achieving financial stability, and realizing dreams and aspirations. Hello, welcome to our YouTube channel. Today we discuss budgeting. This video is divided into 6 parts. 1. Introduction. 2. Meaning of budget. 3. Meaning of budgeting. 4. Benefits and limitations of budgeting. 5. Variance analysis. And finally, 6. Conclusions. Stay with us until the end of the video. Introduction. Budgeting is more than just a financial exercise. It's a strategic tool that empowers individuals and businesses to take control of their finances, plan for the future, and achieve their financial goals. Meaning of budget. A budget is a detailed financial plan that outlines expected income and expenses over a specific period, typically annually. It serves as a roadmap for allocating resources, managing cash flow, and achieving financial objectives. Meaning of budgeting. Budgeting is the process of creating, implementing, and monitoring a budget. It involves forecasting income and expenses, setting financial targets, and making informed decisions to ensure financial stability and growth. Benefits of budgeting. 1. Financial control. Budgeting provides a clear overview of income and expenses, enabling individuals and businesses to track their spending, identify areas of overspending, and make necessary adjustments to stay within budget. 2. Goal setting and achievement. By setting financial goals within the budget, such as saving for a vacation or paying off debt, individuals can prioritize their spending and allocate resources accordingly to achieve their objectives. 3. Decision-making. Budgeting helps in making informed financial decisions by providing insights into the financial health of an individual or organization. It enables better allocation of resources and investment in areas that contribute to long-term financial success. Emergency preparedness. Having a budget allows for the creation of an emergency fund, providing a financial safety net for unexpected expenses or downturns in income. It helps in mitigating financial stress and maintaining stability during challenging times. Improved financial awareness. Budgeting encourages regular monitoring of finances, fostering a greater understanding of spending habits, income sources, and financial priorities. It promotes financial mindfulness and responsible money management. What are the limitations of budgeting? Rigidity. Traditional budgets may lack flexibility, making it challenging to adapt to changing circumstances or unexpected expenses. This rigidity can hinder innovation and limit responsiveness to market dynamics. Time and resource intensive. Creating and maintaining a budget requires time, effort, and resources, especially for complex organizations with multiple departments and revenue streams. It may involve extensive data collection, analysis, and coordination among stakeholders. Variance analysis. Variance analysis is a critical tool used in budgeting to compare actual financial performance against planned or budgeted figures. It involves analyzing the differences between the expected, budgeted, and actual results to understand why those differences occurred and take appropriate action. Variance analysis helps businesses identify areas of success or concern within their financial management and make informed decisions to improve future performance. There are 2 types of variances: favorable variance and unfavorable variance. A favorable variance occurs when the actual financial performance exceeds the budgeted or expected performance in a beneficial way. In other words, it indicates that the actual results are better than anticipated, resulting in a positive impact on financial performance. Here's an example to illustrate favorable variance. Let's say a company budgeted $50,000 for sales revenue in a particular month. However, due to effective marketing strategies and increased demand for their products, the company actually generates $60,000 in sales revenue. In this case, it is a favorable variance of $10,000. This favorable variance may result from factors such as increased sales volume, higher selling prices, or cost savings. Conversely, an adverse variance occurs when the actual financial performance falls short of the budgeted or expected performance, resulting in a negative impact on financial outcomes. Adverse variances highlight areas where actual results are worse than anticipated, prompting further investigation and corrective action. Here's an example to illustrate adverse variance. Continuing with the previous example, let's say the company budgeted $10,000 for marketing expenses in the same month to achieve the $50,000 sales revenue target. However, due to unforeseen circumstances or inefficiencies, the company ends up spending $15,000 on marketing. The adverse variance in this case is $5,000. This adverse variance may be attributed to factors such as increased advertising costs, inefficient resource allocation, or unexpected expenses. In conclusion, budgeting is a powerful tool for financial management that offers numerous benefits, including financial control, goal achievement, and improved decision-making. While it has its limitations, such as rigidity and resource intensity, variance analysis can help mitigate risks and optimize budget performance. By mastering the art of budgeting, individuals and businesses can navigate financial challenges with confidence and achieve long-term financial success.